Gilbert is going to take us through a particular tool that will illustrate the power of compounding, how a property portfolio looks after, let's say, 1 year, 5 years, 10 years, and beyond.
Provided that the growth rate continues, your whole portfolio would be million. Imagine that, right?
It's hard to imagine, but land is scarce. They don't build more of it. This is a really powerful chart.
If you've been around the Australian property scene, you probably know PK Gupta. He's helped thousands of investors build portfolios using data, not hype. And in this conversation, he wanted to deep dive into one thing most investors overlook, the compounding effect. Not just theory, but real numbers. I joined PK on his channel to show exactly how SuburbsFinder's portfolio analyzer works and how compounding growth across multiple properties can turn a 4 million portfolio into over 60 million without unrealistic assumptions. We break down PK's own investment journey, how his 10 properties performed over time, how diversifications across states shape his returns, and how compounding growth lets your portfolio scale faster than you think. Because this isn't just about numbers. It's about seeing what's possible when you start early, stay consistent, and make every decision with data behind it. So if you ever wondered how investors actually reach financial freedom or what your portfolio could look like in 5, 10, or 30 years' time, this part of the interview will change how you think about time, growth, and property investing. So I hope you guys have as much fun as this one. I'm going to listen back to it because I want to build a portfolio as big as this man did. So let's jump into the conversation where PK and I explore the power of compounding growth in property investing.
And I think it's really important not just to buy for, okay, it's going to grow in 4 to 5 years, but we want something to grow right now. And that's because compounding means whatever grows more now is likely to give you even more gains in the future, because future gains come off already more current or very imminent gains. And maybe that can be the segue into the next phase of this episode, which I wanted to give you an opportunity, Gilbert, to showcase this cool tool that you have that shows just the power of compounding. And as you get that up, Gilbert, I just want to reiterate, so many people in my Facebook group that are in their 30s and 40s, they say, I wish I learned the power and the phenomenon of compounding in my teens or in my early 20s. It's a very simple thing. Like, it's so simple you can miss it, but it's so powerful.
Totally, I agree with you, right? So the person who buys on a better location definitely will beat anyone who buys in other parts because of the compounding. It's not only that, compounding lets you scale your portfolio. So this is our portfolio analyzer. So this is just one of the tools that we have in here. And I just plug in all the numbers that you shared in one of your YouTube episodes where you showed your whole portfolio. That's really great that you're being transparent to people. At least they can't say anything about you at all. Like, is your portfolio here? Here's my portfolio, guys. I'm being transparent. And here are the numbers, right? So I plug it in here. All the address that I put in here, these are not your exact property, but these are addresses within those suburbs that you mentioned, right? So looking at this, so I just put here 60, because I don't know what would be the deposit. So I just put here 40 to 50 or 60 LVR, not most, but 10 out of your 13 properties. So the ones that I did not put are the one in the US, the one in India, and your principal place of residence in Gold Coast. So I just put here all the investment properties in here. So looking at it, if we look at it, all of these are green in terms of estimated cash flow before tax. So these are all positively geared already because you started buying at 2011. And then every year you bought 2015, you bought 2. And 2016, you bought 2 again. 2017, and then 2021, you bought 2. Those 6 to 10 properties are all positively geared, right, at the moment. So looking at your total purchase price, let's say you bought all those properties, that's amounting to 4.3 million. And your current market value now is 9.3 million, that whole portfolio. So LVR 41%, in your portfolio equity. It's 2.5 million. So this is just the deposit you have used to buy all of those 10 investment properties, your mortgage, and of course, your cash on cash return of 3.62%. So your portfolio value is 9.3. The growth has been at almost 5 million, which is 4.9. And your total current equity is 7.5 million for all those property. Wow. Congratulations to you. 7.5 equity. That's really, really impressive, man. So, it's a lot to digest looking at all of these numbers. But if we click this analysis in here, we can see here the summary of each of your property. How did it perform individually, the property itself versus the suburbs performance. So you can see here that your Gosford property is 8.48 compounded growth rate from 2011 up to the current year, compared to the suburbs 10-year compounded annual growth rate of 6.2. So all of this, all of the property that you bought has pretty much beat all of the suburbs 10-year compounded growth rate.
Except for Mount Sheridan, which was a disaster. Look at that.
It's not bad. It's 4.97 compared to 5.01.
Oh my God. Things would be different if I hadn't followed some news articles and new casino, Hong Kong billionaire investing in cans.
Well, I'd say 90% is, you should be really happy with that. But still, it's just 0.0. But yeah, I really totally get you where you're coming from. If you bought into a different location, this would have been what? At 6 or 7% growth rate. And looking at here's how diversified your portfolio is, right? So 52% of that is in Queensland. That's equivalent to 4.8 million. 22% of that is in New South Wales. And in Victoria, that's 12%. And in Tassie, that's 14%. That's 1.3 million. So this is how diversified your portfolio is. But the most interesting part, I was blown away when I put in your numbers here, is when I look at this, your journey. Because in here, you started buying at 2011. So from 0 to 9.3 million in 14 years. So 2011, 12, you bought again. So these are the years that you bought your property. And now it's 9.3. So provided that the growth rate continues, so this is what it will look like in 5, 10, 20, and 30 years' time. So you are now what? 35? We were just talking a while ago what our ages are. And you're definitely way younger than I am. So at 65, provided that the growth rate continues, your whole portfolio would be 60.5 million. Imagine that. I was blown away with that.
It's hard to imagine, to be honest. I think probably people who are in their 60s now would never have imagined that their properties would have done what they did in the last 40, 50 years. I mean, when they were buying in Sydney for like $20,000 in the 80s, they probably weren't imagining that the average house price would be close to $1.5 million in Sydney by the time they're 60. But yeah, this is, land is scarce. They don't build more of it. This is a really powerful chart.
There's a lot of people saying, good luck if I even reach age 50 or 60. But let's say, even after 5 years, that will be 11.5 million. Or let's say 10 years time. So in 10 years time, it will be what? 45? And your kid will be just started in high school. And that'll be like 16 mil. That's crazy.
It is crazy. And I think that this is crazy in of itself, but the crazier thing is these are just kind of like long-term averages. I think people can invest way better than I did, to be honest with you, Gilbert, and you probably know people who have much better or bigger portfolios or accelerated faster than I did. But the reason I am able to have my PPORs on top of this and also LVR of 0 right now is because I did property development. So I mean, I don't want to tangent into that, but this is just like average stuff. Like, you can do better than this. Do you know what I mean? And I did better than this as well, and that's why my LVR is 0. But you can kind of get to this level faster because, like I said, I made mistakes. My Mount Sheridan one was pretty terrible, and there was a couple of other properties you shared there where, like, the growth rate was like around 6 or 7%, which is like good. That's the long-term growth rate for Australia. And yes, I got the early gains, which helped the power of compounding. But you can actually get 8 to 10% growth rate, average growth rate over a 10, 20-year period. And people are doing that. I didn't do that as well as people are doing that right now using data.
You've already proven that, because I'd say 9 out of 10 of your investment properties in the portfolio, all of those has beaten the suburbs compounded growth rate performance. Right? So these numbers here, the projections, are based on the suburbs compounded annual growth rate. But given that all of your property has performed above than the suburbs performance, highly likely there's a possibility that these projections is conservative. So it's going to be higher, or the possibility would be higher. It would be higher than 11.5, higher than 16, higher than 30 mil, or even higher than 60 million in 30 years' time.
There's a saying that comes to mind that, when it comes to the stock market, buy the haystack, not the needle. Because it's so difficult to pick the right stock out of so many. But when it comes to property, buy the needle, not the haystack. You can't buy a city like Melbourne. You can't even buy a suburb. You can only buy one property on one street, as they say. So if you pick the needle in property investment, you can do far better than me. Honestly, I think my results should just be used as a baseline, and people should try to beat them, because I think, everyone can do that.
Yeah, definitely. Well, you've proven it already. They just need to be educated, right? So that's why you have the community and you have the education system to help them with that.
Awesome. Well, you've been so helpful, Gilbert, both on the, illustrating the compounding growth tool that you have on the SuburbsFinder's website, which is, what you run there, and also sharing with the worst suburbs in Melbourne. Guys, everyone who's watching or listening, if you want us to cover different cities, I don't know, I never asked Gilbert permission, but maybe he'll be open to coming back on and sharing the worst suburbs in Sydney, worst suburbs in Brisbane, maybe even regional towns, I don't know. Leave those cities or towns in the comments below, and maybe we can have another session. But Gilbert, was there anything that I didn't ask you, or anything that you want to share before we wrap up?
No, it's only one thing that I would share is, when I plug in the numbers there, I was inspired with your portfolio. So I guess if I was inspired, then a lot of people who've seen this should be inspired as well, right?
Yeah. No, I think that's a really good call out. And I'm reading here because I wrote this down. I wanted to finish on this. It says information plus reflection plus application equals results. So just by watching or listening to this, you're not going to get the results, right? You'll be inspired, like Gilbert said. Information's good, but reflect on it. Like, maybe discuss with your husband, wife, or significant other. Show them that chart that Gilbert did. Maybe that creates a business case to convince your spouse to get on the property investment journey. Reflect, like ruminate on it. And then application. Then you actually have to do something. You can't just be on the sidelines thinking. And Gilbert's, website, along with so many other tools that are like online for free, honestly, they are to be used to apply what you've learned. So information plus reflection plus application equal results. So make sure you follow the equation. Otherwise, it's kind of just, infotainment.
Yeah, that's totally or just think of it, what will happen if I don't do anything?
Yeah. An opportunity cost us $60 million as per that chart, apparently.
See? We're 60 mil, right? That's what I'm going to lose if I don't do something. But if I do something, at least I might get like 11 mil in the future, right?
Yeah.
That's better, way better than not doing anything.
Yeah. Or like, forget 11 mil, even like if you make $100,000, by investing in a 400K property, it goes up to 4, 5, 600K in the next 2-3 years. Even that is something. I think everything has its place, and that gives confidence to then take the next step.
You guys, this is wild. Compounding doesn't wait for anyone. It's happening right now, whether you're in the game or out. If this opened your eyes to how powerful compounding really is, don't just stop here. Keep learning, keep analyzing, and take action on the data that actually grows your wealth. So give me a little solid here. Subscribe to our channel. This is how we grow. Also, leave me a review on what you want us to cover next. We're building this knowledge base together. I promise you will do it. Again, this is Gilbert, founder of SuburbsFinder. See you next time.